Okay. So, Ralph, what a pleasure to have you today here. Such an honor to talk to you today, and I hope we can enjoy this conversation. And so, the first thing that we'll ask you is, how's your Spanish?
Very poor. I know
So,
a dozen words I can get by. I can find a text, yeah, but that's about it.
I,
I can take an Uber. I can
I
take
would.
an Uber, but I can't engage in a lot of conversation.
Well, I was thinking to do this interview in Spanish, but well, I guess I had to change my mind.
I can't wait to hear what I have to say then in that case.
Okay, Ralph. So let's start with the more. Tell us more about your background. How you get involved in this business, and how you've been transitioning since the beginning.
So I I was like 19 years old or something, and I was looking for a job, and I had on my best Richmond Brothers $19 rust-colored nylon sport coat, and I took the bus into town, and I was looking for a job as what was called a gopher because they had such things back then. This is a guy, a kid who would go for coffee, go for newspapers, and you do it for tips, and you'd hope to someday, get promoted up to working in the mailroom kind of job, right? And I walk in the door of this place, and it was interesting. It had the ticker tape above and about 50 brokers at desks there, and a bunch of old guys watching the tape. It kind of a pool room atmosphere. And the girl asked me, she goes, "Are you here for the position on margins?" What do I know about margins? What I mean, like what? Margins on a typewriter? What do you mean margins? So I went with it. I said, "Yeah, I know about margins." And she says, "Oh, can you start Monday?" "Yeah, I can start Monday." And she gives me this book, about 3 inches thick, orange cover, and I get back on the bus and I start reading this thing, and the title of it was Federal Reserve Regulation T. I start looking at this, I mean, what have I got myself into? This is going to be kind of a tough situation. So back in those days, they were just programming up the systems to calculate margin requirements for complicated option positions that involved, let's say, a short option, spreads, things like that. So, pairing of the legs to determine the lowest margin requirement. So it's a real baptism by fire for me. I learned about margin, I learned about options, I learned about short sales, and that was all on day one. Okay. And it was doing this on the fly with a moving market, and I was getting paid like next to nothing. And I took like one of my paychecks and I started buying options, and very early on, I connected on a trade. I made more on that trade than I was going to make in the entire next year working this job, right? And
Yes.
it's not that I didn't like the job. I kind of enjoyed the atmosphere, but to me it was interesting because it was Ralph versus the dinosaur. Okay, there was nobody else. It was absolutely, completely primal. And you think, wow, I can make more at this than I could working in a year in this absolutely primal arena. Nobody cares where you went to school. Nobody cares who your father is, what your last name is, where you come from. This is about as primal as it gets, and I love that about it. And shortly thereafter, I'm working down at the American Stock Exchange, and the personal computer is just coming out. I had access to a good price database, people started asking me to program up their ideas, and it was being at the right place at the right time. And the next thing I know, I have Larry Williams calling me and asking me to program up some stuff for him, and that went on for a while. I said, well, you know, because he's got a lot of energy.
Oh yes.
A lot of energy at his age. And
So
when he was in his 40s, he really had a lot of energy. I mean, this guy would not sleep. And he would call me, you know, 2 o'clock in the morning and say, okay, what do you got for me?
at 2 o'clock a.m.?
Oh, he'd call it any time of day. I mean, you know,
Wow.
and it was great because here he's just rattling off these systems, and I'm taking notes. I still have the notebooks from it, right? And I'm
Wow.
writing as fast as I can, and I think, well, this is fantastic. I have Larry Williams, you know, opening up the Sanctum Sanctorum to me, and but he had a lot of energy. He's a tough guy to keep up with.
So are you guys in terms of age, are you guys similar ages?
He's about 15 or 20 years older than I am.
Okay.
I think it's less than 20 years. He's probably about 15, 16 years older than I am.
Okay.
I think around there somewhere. And, you know, he was a big name at this time. And I mean, I was just some kid, you know. And so to me, that was a great exposure to a lot of the business, okay? And in particular because he was a bold guy, okay? I mean, and he is a bold guy. And he would take some bold positions, really bold positions.
Yeah.
You know, I mean, the kind of stuff that makes other people's blood run cold. And well, I really learned a lot from that guy. I've been in the business over 40 years, and you know, I was working for Larry. This was 35 years or so ago, and the big takeaway for me is there's an aspect of tools and techniques and strategies and so forth. And that's the interesting aspect. And I think that's the aspect that people really focus on and so forth. That's the fun part. The more important part is that to implement them really takes patience and nerve. And I've seen very few people who can do that. Larry could do that, okay? I've seen one other guy I've ever met who could do that. And then one other guy in Japan who I just met in passing who has done that. I take it back. I've met 2 other guys aside from Larry here who can do that. But that is really, really difficult to come in and day out, making decisions based on the exact same decision-making process, regardless of what's going on with you in life outside of the trading, and particularly when the heat's really on with the trading and you're in a drawdown, because you're either new high equity or you're in a drawdown. And so most of the time you're in a drawdown, you don't know when it's going to end, and you don't know how deep this is going to go. And that can be very wearing on an individual, especially if you're trading other people's money.
Yes.
And it's that ability to deal with that and to compartmentalize things, to take all that crap, the clients, the noise, everything else that's going on, and put it in a box. Put the box over here and say, right now, I'm focused on implementing my deal on this screen today, right now. That's it. And no matter how much pressure you're under, to continue to make the same exact decisions day in and day out, particularly when these decisions want you to make bold, nervy moves. It's very, very difficult. Like I said, there's very few people who can do that. And I think that really trumps any strategies or techniques, or whether in terms of timing and selection or money management or so forth. Those are the fun things. Those are the interesting things, okay? And they do interest me a great deal. It's my passion. It's your passion, or we wouldn't be talking tonight. But, and I don't mean to get sidetracked here, but I can't drive that home enough. And especially in recent years, this has become even more illuminated to me how critical that is, you know? And I think a lot of people treat that as an afterthought. You can't in this business.
Well, you know, that's something really interesting what you're saying. Your friend, your mentor, in this case is Larry Williams. My mentor, my friend is Ralph Acampora. Actually, as you can see in my back, I have a point and figure charts made by Ralph Acampora from 1966 to 1984. And he signed it for me when there were no computer. I had to do it by hand. So I had to, you know, the X and the box and box size and everything. So this is the first question that I have for you before we can jump in your paper and we can analyze it. Is do you work in any strategy that was related to the point and figure charts?
Yes, but only because when I started in the business, of course, everything was done by hand.
Yes.
And point and figure was the especially the Larchmont, the Chartcraft book. You know, that's like the Bible of that. And that was really how I started learning the business. The technical side of the business was from that. So I come from that standpoint. And then I was introduced to Edwards and McGee and so forth by a friend who worked with and so forth. So I think that point and figure, and you know, when you learn a certain structure of something, you look at a price chart and you say, it can be an ordinary price chart, but you say, there's a triple top in there. And in your brain, you're seeing it as a point and figure triple top. So I think it pervades everything you do technically when you come at things from a certain perspective. Like, and my perspective too was, you know, I mean, in Lower Manhattan in the early 1980s, that's what people had in their back pockets. They were walking around with hand-kept point and figure charts, right?
All right. So, okay. So let me share 1 second. We can go over this so you can see here. Okay. This is the last paper that you sent to me. About the maximizing risk adjust returns. Can you tell us more about what inspired you to write this research paper?
So I wanted a way to demonstrate a number of things, particularly for prospective clients and institutional clients, that was devoid of math, but a more graphical presentation of what goes on in reinvestment, particularly with respect to the idea of maximizing risk-adjusted returns, okay? So this was really an attempt to tie together a number of things in a way that didn't require some pretty heavy-duty math involved in finding. I mean, if people want the heavy-duty math behind some of these things, you know, again, the paper with Lopez, DePrado, and Zhu, you know, they can dig in pretty deep, and those are referenced in this. But I really wanted a graphical presentation of the ideas here, and I think I've been planning this for a long time and putting it off. And then I asked you what you wanted to talk about today.
Yes.
I thought, you know, I really need to get that paper together because it has the graphical representation of these things in the right sequence. It was the right time for me to finish this thing off.
That's wonderful. I really appreciate it. So let's start with this example, okay? So with the coin toss. Okay, how it just thinking about one component, correct?
Right, we're only talking about one component throughout this. I'm keeping it simple, let's say. So
Okay,
I'm talking about a portfolio of one component.
just one
One
component.
proposition. Yeah, one proposition.
Okay. So,
Let's go back to the first chart one real quick. Okay. In that first chart, that single red line represents on the left axis the multiple you make on your stake. And the proposition is a coin toss that pays you 2 units on heads and costs you 1 unit on tails. The left axis, the vertical axis, is the multiple you make on your stake. And the horizontal axis is the percentage of your stake you're risking. In the far left, if you risk 0% of your stake, the multiple you make on your stake after one proposition is 1. If in this 2-to-1 with a 0.5 probability of heads and tails, both, if you risk 100%, you would expect to make 1.5 times the multiple of your starting stake. And so it's just one trial of this 2-to-1 coin toss proposition. So if we go to the second slide and we say, okay, now what we have to wager with on the second toss is a function of the outcome of the first toss. And we're going to do 2 consecutive coin tosses, okay, this proposition. That purple line represents what we would expect to make if we quit after 2 plays, risking various fractions of our stake on each play. And you can see, because of reinvestment, that curve, that line now bends into a curve.
okay. So let's go to the next one.
Right, so let's say we're going to do 3 propositions. So if we look at one proposition, the straight line, in this 2-to-1 coin toss, or anything where the expectation defined as the probability weighted mean outcome, okay? In this case, 0.2 times 0.5 plus minus 1 times 0.5, which equals positive 0.5, is the probability, the probability weighted mean outcome. It's like here. And so that would represent 1.5 times on our stake. That's maximized for one play, risking 100%. When we look at reinvestment, after 2 plays, that purple line, that peaks out at 0.5. So if we were to quit after 2 plays, and we wanted to be growth optimal after 2 plays and quit, we would risk 50% of our stake on this run of 2 propositions of this 2-to-1 coin toss. I think it's a blue line on there, representing 3 plays, now moves farther to the left. And I believe that peaks out at 0.375. And so if we go to the next slide, if we go to figure 4 here, this has 8, or goes to 8 tosses, then 12 tosses, but you can see the peak of each of these as we increase the number of trials, called N. That peak continues to move in a leftward direction. It continues to drop. Whereas at one play it was at risk 100%, it drops down and it reaches an asymptotic value. And the asymptotic value in this 2-to-1 coin toss proposition is at 0.25. Okay, so if we were to trade, and I think it's somewhere around, I don't know, 20, 30, 40, 50 plays, it gets very close to 0.25. It never quite reaches 0.25, but for any finite number of plays, it's going to be a little bit above 0.25. And then we go to the next slide, okay? And okay, this one, the main blue curve here, and the others gets squished out because the scale changes, because we're looking at 40 plays of this 2-to-1 coin toss. And that peaks, let's say, right around 0.25, where the multiple we expect to make on our stake is 12.55. So that kind of swamps out the other lesser plays. But you can see, as the number of trials increases, the peak is not only moved in a leftward direction towards its asymptotic value, in this case of 0.25, but it's also gone up, okay?
Yes.
And as it goes up, its shape changes. If we go back up to slide 2 real quick, one, okay, you can see at 2 plays we have a curve, right? And it's just a bowl-shaped curve. There's no, it's concave down throughout the course of the curve, okay?
Correct.
And if we go to 5, let's say, and it begins to be visibly apparent at 40 plays, I think it's mathematically apparent around 11 or 12 plays. Go down to figure 5, please. Okay, at 40 plays, you can see at the leftmost value of that light blue curve, it's actually concave up. And then it rolls over to being concave down. Hits a peak, it's concave down, and as it comes down, as it approaches 0.5 for a value of F, it's actually concave up again at that point. So if we scroll down to figure 6, that shape gives us, where that shape crosses over from concave up to concave down is an inflection point. We're really not, there's also an inflection point to the right of the peak, but we're not concerned with that. At least not in terms of looking to maximize the geometric growth function. But that inflection point, if you say the value along the left, the multiple you make on your stake is gain in reinvestment, and the fraction you risk, the horizontal axis, is risk, then when it's concave up, you are gaining at a faster rate than your marginal increase in risk. Your marginal increase in gain is outpacing your marginal increase in risk. And when you hit that inflection point, that changes. Now, for every marginal increase in risk, you're getting less of a marginal increase in gain. So that inflection point is just as the peak is geometrically critical in reinvestment in terms of maximizing geometric growth, so too that inflection point is a geometrically critical point in terms of maximizing risk-adjusted return, at least in terms of maximizing marginal increase in risk with respect to marginal increase in gain.
Okay, okay.
Right?
Yes.
And then if we go to the next figure, the next chart, once an inflection point appears, then also we can draw a point that's tangent to the curve. And the reason that starting from the point 0, 1, okay, a multiple of 1 on the left axis and a value of 0 on the horizontal axis. That tangent point is another point that's geometrically critical because that point represents the point on this curve where the slope of that line is the greatest. And that slope represents risk to reward, okay? So that is the point where we're gaining the greatest risk, or the greatest reward to risk is at that tangent point. Do you see that?
Yes, 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 I see it.
Okay, so those then, that tangent point and the inflection point are our two geometrically critical points of risk-adjusted returns when reinvestment is concerned, okay?
Okay.
And again, if we're looking at a two-component or two-proposition outcome, we have a manifold in 3D space rather than a 2D space manifold. We have a curve. And again, there's tangent point, inflection point. For the math to that, again, I go back to the DePrato and Zhu paper referenced in this one, or off of my website.
So does this apply for a multiple strategies with multiple components too?
Yes, it does. It certainly does. I'm only demonstrating here for one for the sake of simplicity.
Yes, correct.
You could do it for, 1,000 components in a 1,001 dimensional manifold and find the inflection point and the tangent point in that. And we provide the math for that. The 40 play one now, because you can see our left axis, the vertical axis, is going from 12.55 for the peak of the blue line at 40 plays to somewhere north of 350 for multiple on our starting stake at 100 plays of this. And you can see the shape of the curve gets ever more pointed as the number of trials continue. And then we go to the next one, the next slide. And so here we're looking at inflection point, okay? And the problem with the inflection point is as that peak gets more and more, as the curve gets more and more peaked, as the number of trials continue, its shape is changing. It's getting to be more and more peaked. At the inflection point, whereas at 40 plays, I think it started at 0.18 for the inflection point or the tangent point. The inflection point started at 0.13, and then it migrated, I think, to like, I forget what it is. Scroll up a bit. I got the value there. Just go to the previous page. Just a little scroll up so I can read this. No, up. Okay, stop. Okay, so you can see at 40 plays, the inflection point was at 0.13. At 100 plays, it's moved to 0.18. Now remember, the peak, which has moved down from 1 as n is increased, is settling into its asymptotic value at 0.25. The inflection point, however, is migrating upwards as the number of trials continues, okay? And then scroll down, and okay, that shows it for the inflection point. And then we go to figure 10, and here we see it for the tangent point, where at 40 plays, the tangent point's at 0.18, and at 100 plays, that tangent is at 0.23. So that tangent point is going from 0.18 at 40 plays to 0.23 at 100 plays, and eventually it too will settle into that asymptotic value of 0.25, which is also the growth optimal point.
Okay, okay.
So both of these critically important points on the left of the peak on the curve that represent points of the critically geometric curve, risk-adjusted returns, migrate towards that asymptotic peak as the number of trials continue. So they also have that same asymptotic peak. The only difference between that and the peak itself is the speed that these points migrate towards that peak.
Okay. Scroll down.
That's okay. So then here we show it where n is the number of trials on the horizontal axis, and f is the value on the vertical axis. And you can see they're converging on that 0.25, albeit at different rates.
Okay. So let me just move to the. Okay.
Okay, so if we look at coin tosses in this case, or any proposition, and we break down each outcome of the proposition to a holding period return, let's call it, okay, which would be 1 plus the return made on that proposition for that outcome, okay? And so we have two outcomes to this proposition, plus 2 and minus 1, okay? And that's then a function of what the fraction is that you're risking, okay? So if we look at those, rather than using the raw values of the outcomes of these propositions, but as holding period returns, we see that the average gain per play, which we call G, okay, which is, let's say, where that curve is at n plays, okay? So at 40 plays, we saw the curve at 12.55, and we would say, okay, that its geometric average, G, is at 12.55 to the power of 1/40th, because it's over 40 plays. So it's 1.06066, okay? Then we would also look at the arithmetic average of those outcomes and the standard deviation of those. And they fit very neatly to the Pythagorean theorem, okay?
Okay.
And depending on the distribution of these, it's either exactly Pythagorean or pretty damn close to it. One of the papers that I referred to you on and it's referred to this in this too, the 2020 paper on malevolent growth goes into how close to Pythagorean these things are. And if we scroll down to the next slide, and here the blue line represents that curve for G at different values for F, different percentage of our stake we risk, okay?
Okay.
What we expect to make in terms of the geometric average, that's the blue line, which corresponds to the vertical leg of the triangle. We can see how the shape of those triangles comport the height of the triangles, and thus their shape comport to that blue line as demonstrated in figure 13. So we can then say that that horizontal axis can represent either the fraction of our stake we're risking, okay, we're going to slide down to the next slide, or to the cosine of the standard deviation in holding period returns over the arithmetic average holding period return, okay? So that scale on the bottom graph, they're interchangeable. They can be mapped to each other, okay? There's a mapping of the curve there. And similarly, so we're looking at the cosine here as the height of G, but if you look at something like Sharpe ratio, where you're taking the arithmetic average return divided by the variance, we'd be looking at, let's say, a mapping that would be constructed by the secant of A over SD squared, the arithmetic mean over the variance. And it would be the secant to comport to that. So these mappings between F and these trigonometric values we can do. So we can be interchangeable with that. And so the point is that if you're looking at something like, say, Sharpe ratio, okay?
Okay.
You're comparing the F value of one system, okay, with the F value, the leverage of another system. You aren't comparing directly two different trading approaches. You are comparing two different trading approaches, but you have two different amounts of leverage that you're using in two different approaches. And my point is that that latter factor, that amount of leverage, is likely to return to affect the returns and the distribution of those returns more than even the trading approach itself. So it can be very, very deceiving. And the second thing too is you can gain Sharpe ratios and Sortino ratios. You can gain to drawdown. All of these metrics are easily gained, okay? If someone were so inclined. I don't want to go down that avenue tonight, what we're talking about. But that really is the crux of the paper. Now, you ask, okay, how is this differ from Kelly?
Yeah, that's a question to ask. What's the
Right,
difference from Kelly? Yeah.
okay, so a couple of things. First of all, we saw with Kelly, you have one value, okay, the asymptotic value, okay, and we see that you're always going to have an amount. You're always going to play for a finite number of plays. So what's the real growth optimal value? Okay, and it's not the asymptotic value. It's some number between greater than the asymptotic value up to possibly 1 if you're going to quit after one try. Okay, if you know how many trials in advance you're going to do it for, you have a number that could be considerably different than Kelly. The second aspect is, you know, I would get this all the time from guys. They'd say, you know, I have a Kelly criterion answer that's a number greater than 1. What do I do? And it's because a lot of times, and this is why, and I can't believe that Kelly, especially with Shannon overseeing that paper, didn't pick up on this, okay? Because to me, this was a gross error. It deserves an F if it were a homework assignment. But I know these guys weren't traders, but unless you scale to the largest loss, you really don't have something that is the optimal fraction to trade. You have really what's an optimal leverage factor, an optimal amount to multiply your account by. So the Kelly criterion solution, and the solution you get using, let's say, the formula that I propose for optimal growth optimal fraction, is the difference is that you have to scale by the largest perceived loss that you can experience, okay? And if you can actually truncate that physically in real world application to some derivative product or so forth, all the better, okay? But that's a critical thing. I mean, you can't even apply it to short positions. It's just not. People have so misapplied this one. I mean, even in blackjack, you don't know what you're going to lose on a given hand.
Yes.
Okay? So, oh, the Kelly criteria says I should bet 3% on this hand. Bullshit. You don't know if you're going to be doubling price, winning what, how many times that can go. Depends on what the table rules are and so forth. I don't
because you think the odds are different when you're playing like blackjack games or like doing on the market where you have 50-50.
Right. I mean, Kelly is a subset of this broader picture. It's the asymptote where the proposition of what you can lose and what you equals what you put up. Okay, and that's not always the case. It's almost never the case in trading. Okay, in capital markets. So that's one part of it. Here's the bigger part too. And it gets to a bigger idea. And to me, it's the biggest idea, at least in the theory of this. So there's an idea that says, you know, when you observe a physical process, you change it simply by observing it, right?
Yes.
Kind of an odd analog in this that says, if you participate in a process, you are going to experience a different process than what we look at asymptotically, okay? So, and it's not evident, let's say, in a coin toss, but as you get to more perverse distributions, and again, let's take a, you know, we're going to spin a wheel, and there's 10 numbers on the wheel, right? And for 9 of those numbers, you're going to win $1, and on the 10th, one of those numbers, you're going to lose $10, okay? So the expectation is used throughout game theory and all of this says, wait, you don't want to play this because the probability weighted mean outcome is to lose 10 cents, right? And that's true if you have ever more players coming and playing it, okay? That's true if I have a team that's going to go play it. That's true if I'm the house playing it and I have guys come and play it. That's true for me if I'm going to just keep playing the thing. But for a finite sequence, okay, if I play that for 6 plays or less, I would expect to make money. And we could go into the math, and that's in the 2019 paper. But more than that, let's say, the Kelly criterion solution would never allow you to wager. You would get a number of 0 on that, okay? The asymptote would be 0 for that. But for a finite number of plays, you are going to want to wager a positive number. You are going to want to accept that wager and wager a positive number. And I propose one, we do this every day, and we do this innately, okay? When you get in your car to go to a job in the morning, you know you can get killed on the freeway out there. There's no gain for that. That's a terminal event.
Yep.
Yet, don't do it anyhow. And we're hardwired on Earth that to take wagers of finite length with a negative probability weighted mean outcome, if for a finite length, we expect, by my definition of expectation for an individual participant, as defined in this paper, we expect that for that finite number of outcomes, we will be profitable. And so this gets into inputs to the optimal fraction determination, okay? That Kelly criterion does not look at those, and that's really critical here in terms of what you use for inputs to it.
People, okay? Let me stop sharing this, okay? Let me go back. So the first question that I have for you, Ralph, is coming from a friend of mine who's an economist, Venezuelan economist. His name is Andres Trujillo, and he asked you how to know when a trading strategy edge is no longer valid. Sorry, I cannot hear you. Cannot hear you.
Italian food I ever had was in Caracas.
Yeah, he's in Caracas, Venezuela. So how do we know that?
Yeah, sweets there. Beautiful. Well, I'm afraid I can't answer that. When a hedge is no longer valid,
Yeah,
I don't know if you ever want to not have a hedge on there, solely for the sake of what we got picked. If you have a hedge in there such that you can truncate worst case, what would happen? I think there's a big benefit to be gained in terms of plotting out your money management strategy by being able to say, okay, here's absolutely the worst thing that can happen. So I don't know if you would ever, at least by my way of thinking, and that's not mathematically rigorous in this case, but I don't think you'd ever want to say that you don't want to have that hedge on.
Okay. So the thing is, when you're like testing out a system, okay, and it's working fine, but and then you putting on real, okay, so start like being erratic. I think is how do we know when to stop using that strategy based on that criteria?
So that's a great question, but it's also a possible pitfall. I mean, strategy drift is a real pitfall in any of this, okay? So I think you need to, if you have a strategy that you're going to start implementing for real, you want to make sure that, so as to avoid strategy drift, you want to make sure that things are robust enough, okay, that you will be able to keep on trading this. And again, This gets back to the patience and nerve. But if you're trading something that market conditions in the future might turn into a negative expectation for longer than you can hang on for, I think you might want to not even go ahead with that type of system, you know.
Okay. So next question is coming from.
People suffer from strategy drift one, okay, then they do the strategy blowing up because they don't have the patience and nerve to hang in there until conditions return favorable to that system. So they start drifting around and they're lost. You're lost when you start doing it.
Okay.
People,
okay.
When they start looking at, they all go back to cycles and seasonal. It's a very predictable path that people go into when they start going down that black hole.
Okay. So this question is coming from my friend Alberto Cardenas, and he asked you, what do you think about the 2% risk per trade? That's a common term in the industry. What do you think about that?
So some people look at like 2%, 1%, and so forth. And they're legitimate. If you look at the paper, okay, and you look at like, I guess it's slide 6 or 7, so we have like the 40 plays, okay? And you have that curve in there, and that 2% risk has you way over there in the left corner, okay, from the concave up and way down in here. It's not a point of any great critical importance, but if it's something they're comfortable with, then fine. I myself would say, in that case, if it were a 2-to-1 coin toss and the asymptotic peak is at 0.25, I would say you want to take 8% of your stake, take 92% of your stake and put it in a whole life insurance policy, take 8% of your stake and trade it at that 0.25 peak, okay? And be growth optimal on that 8%. And if that grows to a number that gets sizable such that you're not comfortable to continue to trade it at that amount, take some more off and buy some more life insurance with it. I mean, that's how I look at doing things. I think you really have to trade things at the growth optimal peak, particularly, and this is where the paper gets into, if a manager is doing that with client funds and charging them fees on it, the client has to look and say, wait a second, he's only trading 8% of my money at the peak, and I'm paying him fees on the other 92% of the money that's just sitting there, okay? Yeah. I can keep that money and have it just sit there. So I think that the client would be wise to say, I want you to notionally trade this at 12.5 times as much as you would, okay? And I'm only going to put 8% of my money in here. And the rest.
Okay, let me see. Because this guy, he's in Argentina. He's one of my friends too. His name is Ivan Sherman. I don't know if you heard about him. And he's CMT, and he used algorithmic trading, and he used one of your research to develop his entire hedge fund. Okay, so he asked me, can you ask Ralph, have you considered combining fixed ratio with fixed fractional?
So I don't want to get into a long discussion.
No, short. Yeah,
there's a lot of people who don't know the difference who could be watching this. But let's say fixed ratio and fixed fractional, they cross over at a certain point, okay? And that crossover point is a function of time. So we can pre-calculate at an N of 12, say, we're better off to go from fixed ratio to fixed fractional and so forth. And anytime you do that, like trying to calculate, well, I want to be at the inflection point for 20 periods, 20 quarters out, or the tangent point for 16 quarters out, 4 years from now or something, it gets very delicate. I mean, you're really depending on things turning out in the future exactly as they have in the past. And looking to switch horses mid-race like that, you're really asking for, you know, a perfect track and the horses to line up just perfectly and so forth. It's a very tricky thing to do. It's just not robust enough for me to consider in the real world. It's an interesting theoretical exercise, but, you know,
Okay.
launching myself to Mars in a garbage can is an interesting theoretical exercise too. I'm not going to.
That's
Wow, an ambitious guy, Juan. Very ambitious man.
well, you know, I'm feeling like Larry Williams when you're describing sometimes I don't sleep. My wife doesn't understand that, but based on what you're saying, I think my path makes sense.
Yeah, yeah. No, it does. It does. I mean, it's great that they have these paths nowadays. I mean, it used to be if you wanted to learn about any of this, you had to go hang out at, you know, the New York Public Library and dig through old stuff, you know, about GAN and so forth to try and just look. Where else do you find out about any of this stuff back in the old days? Now, I mean, it's good that this stuff is, you know, there's like a repository of information and so forth, and it's a very dynamic and alive community. It's really come a long way, and I love seeing how vibrant it is. You know,
Okay.
there's just so many great contributions going on, and so much colonization from around the world by guys like you and other really charismatic people. It's come so far in such a few decades. It's astounding. It's really astounding.
Yeah.